What's up, traders? Today is Wednesday, February 21st, and as usual, doing some recaps from a trade we took yesterday. So yesterday we had an amazing trade for US 30 that gave us a 1.5% return. So doing trade recap for Tuesday, February the 20th. So we had a nice trade right there. So yesterday we did something a little not too different. So this is something that we used to do. So when I first started this community last year in March, we didn't have the SAR strategy by then. So we were using supply and demand, or support and resistance, in conjunction with trend lines. And by then, one thing that we used to use to check our supply and demand zones was our GA Trading Club zones indicator. But as time went on, I moved away from using ideally supply and demand, even though what we're doing right now with SAR strategy is technically can be related to supply and demand. But I stopped using the zones indicator. Now the zones indicator, before I do the trade recap for yesterday, if I turn it on, the zones indicator shows us where buyers are sitting and sellers are sitting. So in this instance, the green zones are where the buyers are sitting, the red zones are where the sellers are sitting, and you can see how price is rejecting from such zones if it comes back to them. Now, here, what I discovered, the reason I chose to go back to using this or adding it as a confluence to our SAR strategy, which is the main strategy we trade, is because over the last 2 weeks, I took back-to-back losses on US 30. So some of these losses, like the previous week, I think I took maybe 5 or so consecutive losses on US 30, and that is odd to me because ideally, having traded US 30 or having been trading US 30 daily for the last 3 or so years, I've become accustomed to it. So I had to go back and kind of reflect and see, why did I make those losses? So one thing I realized is that when I applied the zones indicator in some of the trades I'd taken losses at, maybe I was selling, even though the SAR entry was valid, the zone where the SAR entry was valid, maybe if we were looking for sales, the zone was like a demand zone. So ideally, right, selling into where buyers are, or sometimes maybe buying into where sellers are. Or the other part is trading in no man's land. What do I mean by no man's land? No man's land is ideally between where the sellers are and the buyers are. So like, for example, here, and we'll go over an example of like a trade setup from yesterday where I chose to stay out of trading in no man's land, because ideally you want to trade with a trend, right? They say the trend is your friend. So if you're selling, you would want, if you turn on the zones indicator, you want to see sellers sitting there, or even order blocks. Now that's the other part too. We have the markups indicator that shows us where the order blocks are. But this is just a nice little confluence that I saw that we needed to bring back into a trading in order to improve our trading results. And day one of applying that, we had a nice win for US 30 and we had an amazing entry. So here, let's go over the trade from yesterday. So I'll just apply the bar replay tool because I'm reviewing it like later today, or I'm reviewing it like a day later. And also we were also looking at the 30-minute time frame as well. But anyway, we'll go over, actually give me 1 second. We started off with the 30-minute time frame. There we go. Let me think this through. Somewhere there. I think this was during, this was during the live session. So looking at the daily bias for US 30 for us yesterday was bearish, gold bearish, EU bearish, and the dollar bullish. Now a nice thing we saw for the dollar, you can see the previous SAR level was here. So the dollar was bouncing off of this support level, or this previous closure above bullish SAR that made us be bullish on the US dollar. So we were definitely looking for sales on gold, EU, and US 30. So the only trade that came up as a possible trade was the US 30 trade. Now here for US 30, we were looking mostly to trade the 30-minute setup. We had a 15-minute setup, but we were looking to catch the 15-minute setup. I'm sorry, we had the 15-minute setup, but we were looking to catch the 30-minute setup. The reason for that, if you guys remember during the previous recap, I talked about if you have either two time frames that give you the same entry, or if you have multiple zones that are given by the same entry, you need to look for the optimal zone. So for example, if you have 3 test and rejection zones that have been validated by one setup, you want to look for the most optimal zone. So if you're doing sells, you want to sell at the highest zone. If you're looking for buys, you want price to come back to the lowest zone. Now if you have the same setup given by 2 different time frames, the higher time frame gives you more probability. So we had a test and rejection here. So if you can see here on the 15-minute time frame, we have this test and rejection entry. So you have your test candle, you have your rejection candle. Also here on the 30-minute time frame, and you can see both of them validated around the same time. On the 30-minute time frame, you have your test candle, you have your rejection candle. Now here, one thing is always ask yourself, relative to where your entry is, how far are the SARs you're trading? So in this instance, what I was expecting here is something of this sort. So I wanted price to retrace just a little bit further up because I did not want to enter on impulse just yet. And then comes in the zones indicator. We want to see if we're looking to sell here. If I turn on the zones indicator, I want to see sellers sitting there. So we came in here, turned on the zones indicator, and boom, look at that. We had sellers sitting here. Now a red flag would have been if we see green zones here, because that would have told us that we have buyers sitting here. But then you can see within this whole selling zone, there's some zones that are darker than others, right? So that's what I call like a supply zone within a supply zone, or if it was a green zone, demand zone within a demand zone. So that means within that zone of sellers, we have specific zones in there that have more sellers that are concentrated in there. So seeing this, I wanted price to retrace a bit further up so that at least this supply zone within a supply zone is about in between my stop loss. Now here, price did not come back up just as of yet, and it melted to the downside. It first melted to the downside before coming back up. So at this point, the trade was at break even. I think I remember that one on the 30-minute time frame. The candle actually started going down before it came back up. So for this particular trade, it would have been at break even. Now, all wasn't lost because we had now the 15. So I'll just go ahead and exit that entry. Exit here, turn off the zones indicator. So then I told folks, since the 30-minute time frame, price had gone down first, and then I hadn't already hopped into the trade because I just needed some retracement backup. So I wasn't trying to chase a trade that somebody else would have been at break even. So I said all wasn't lost. We had a 15-minute setup as well. Now on the 15-minute setup here, if I go here and do the bar replay for you, initially we had this zone that's down here. So I want to show you guys the no man's land that I was talking about. We had this zone down here that we were looking to trade. So we were looking to possibly catch a break and continuation, but it invalidated. But just as an example, if this zone had validated, if this if this continuation candle had closed below this zone, and you turn on the zones indicator, or below that SAR zone, and you turn on the zones indicator, and let's say this trade had validated down here, it's not a trade that I would have taken, and it's not a trade that I'll take going forward, because this is what I mean by no man's land. Because if you're looking to sell, look, there's no seller sitting there. It's just nothing. It's just in the middle of buyers and sellers. And given that price had come from a demand area, you can see that buyers were riding momentum up. So that's what I'm talking about. Like in future, even though an SAR does validate within no man's land, we're not taking that trade. We would be looking at where is price probably going to grab liquidity, because again, you want to trade in the direction of the trend or of the smart money. Now if I turn off this zones indicator again, so of course the break and continuation did not validate, but we had the test and rejection. So this is your test candle, tested this zone, this is your rejection candle. So of course this trade validated down here, right? But then you guys know how I do. I always ask myself before I take this trade, even though the trade validated down here, relative to my entry. Where is the SAR zone I'm trading? The SAR zone is about 80% of my stop loss. I'm not willing to do that. So what do we do from there? What we do, we wait. What we do, we wait for price to retrace to our SAR zone, but then we also need to mark up anybody who had taken this trade without worrying about overextension. Where would they set a 1:1 risk to reward? So same thing that happened with the 30-minute time frame, because we want to know if somebody does not care about overextension and achieves a 1:1, where would they be setting break even? And if they've already set break even for that particular trade setup, there's no need for you to wait for price to come back to enter the same trade, because ideally you would be entering a trade that somebody else is already at break even at. So they can end up at break even for the day, but if you're chasing that trade and you get stopped out, you end up ending the day in a loss. So here we did the arrow right here, and we were expecting price to go back up. Now, what's our new confluence we talked about? Turn on the zones indicator. By turning on the zones indicator, this was perfect for us because it told us that the SAR zone that we are trading, we have sellers that are sitting there. That is literally what you want. And at this point, since we were waiting, we knew there were sellers up there. Price came back up a little bit, and then at this point, around this point, that's also when the 30-minute candle was also closing, because I was also anticipating another test and rejection entry on the 30-minute, but this rejection candle on the 30-minute closed above the SAR, so the 30-minute setup disappeared. So I told people in the Discord, if the 30-minute candle would not validate, and then we still had this 15-minute candle that was testing our zone, and if this 15-minute candle closed anywhere above this zone, like around that zone, I would be taking the trade. So at this point, I told people, and you can see here the importance of drawing this line, because here you want your trade to be filled in first before this person achieving a 1:1 risk to reward. So you can imagine somebody who, as much as the trade was valid down here, anybody who chased this trade, they would have gotten stopped out right there, and it's ideally a fake out. So those fake outs that we were getting constantly the previous 2 weeks, when I looked back into them, it's because because normally our daily bias is normally not that wrong. Very few times have we been bearish on an instrument and then the instrument keeps becoming, say, bullish for the rest of the day, or vice versa. So very few times. More times than not, we normally just get faked out and price comes back in our direction. So that's why I went back and back tested over the weekend and said, how do we avoid these fake outs? How can we? So, and I saw by using the zones indicator, it tells us like where price will probably go first before maybe going back to our entry. So you can see anybody who had taken the trade upon validation here just gotten faked out or stopped out. So at this point, price came to us first before going down, which is what we expected. Now at this point, since I knew we had sellers here, I told folks that I was selling US30 based off of this test and rejection. With the official trades, I count using a 0.75% risk, but again, as you guys know, personally I risk 1% per trade, but the results that I count are based off of the 0.75. So I say selling US30, folks should use 0.75% risk, 50 points stop loss, 100 points TP, and then I entered the trade there, like live on the live session just yesterday. So here I'll go ahead and do this first so that we can see where stop loss was, and also looking at where our stop loss was. Excuse me, our stop loss was protected by all these supply zones within supply zones. So we had heavy selling pressure there. That's what you want. That's what you want to see. And if I turn that off, you can see how this trade resulted, and it was such an amazing trade. Barely little drawdown, and then came back, right, because it was peak. And also, if we turn on our markups indicator, we had a 4-hour bearish low sitting here. Let me show you guys here. So the markups indicator, looks like it has, I'm not sure if it's going to load. Give me 1 second. See if we get, we do this markups indicator, there it is. We had this 4-hour bearish low that was sitting around our entry, or did that change? Yes, we had a 4-hour bearish low here. So if I line that up, we had a 4-hour bearish low here, and then let me turn that off so that it's a bit more clearer. We reset. Perfect. Let me reapply the bar replay tool. So we had this 4-hour bearish low, the blue line there. So we have a 4-hour bearish low order block, and then what I was looking for here, I needed this 15-minute candle to close below the 4-hour bearish low, because what that tells you, they were coming up here to grab liquidity, right? The red zones to grab the sellers, and then if it closed below the 4-hour bearish low, picks up that momentum of that order block, and we expected a meltdown to the downside, and there you go, right? There goes that meltdown, and it was such a nice trade. So we used to get like barely no drawdown trades, so looking forward to bringing those back, or to having those back, especially just by tying some of these things in. And yes, having too many confluences sometimes can cause you analysis paralysis, or can cause you maybe to miss a trade because you're still checking to see if your confluences align. But if you align, if you set ample time to review your trades before they validate, then you should be golden. But that was such a nice trade. Personally, I made 2% for the day yesterday, but I recorded 1.5% because with a 1:2 risk to reward, we using 0.75% risk, we won that trade. That's 1.5%, and that brings us for the month of February with a current gain of 1.5%. And you can see, if you go to our Discord, I posted the results of that trade. This is the trade that I took yesterday. You can see with a 200k account risking 1%, that was a 4% gain. And I'd also done a screenshot of it, I think, after we were done in the live session, right? So we ideally caught the top. So this was my account yesterday before we hit TP, and you can see our entry was right there at the very top. So those are the trades we want. Those are the trades we want to follow on or improve on going forward. And once we do that, we'll have a nice trading return for the rest of the year. But anyway, we'll see how the rest of the week goes, and I will catch you guys on the next trading recap. Peace. What's up, traders? Today is Tuesday, February 27th. Just doing a trade recap of a trade we took last Friday. That was Friday 23rd of February. Now, to kick things off here, let me just apply the bar replay tool right here. All right, so this was the trade. It was based off of this SAR zone up here. So this SAR zone, we had a possible break and continuation. So right here you can see this was your break candle, and then if we go to the next candle, was your continuation candle. So we had two consecutive 15-minute candles closing above an SAR region. Now our daily bias by then was bullish on EU, so we turned bullish to have a bullish bias on Thursday. So Friday was the beginning of our bullish bias. So going back to that trade, so the other thing, if you remember during our previous trading recap, we had talked indicators tells us where the buyers and sellers are sitting. So if we are buying, we would want to be in a demand area, or where buyers are sitting. If we are looking to sell, we want our zones to be in a supply zone. So here, if we apply the zones indicator, you can see we had this demand zone right here. Now this demand zone was based off of one candle, but nonetheless it was a demand zone, and I'll go over something about it after I finish this analysis. So here, this was perfect because we were buying in a demand zone, so this had checked off all our boxes. So as you can see here, price started off bearish, so we started off in drawdown, and then we ideally started off again coming back down to this other demand zone. So we had two demand zones, so there was that one up there and then this one below here. Now as you can see, as we started turning bearish, that demand zone right here was mitigated, so all those buyers were excuse me, were taken out. But we had this demand zone again, another demand zone down here. Now the difference between the first demand zone, if I go back a candle, 2 candles, so I want you guys to see the difference between these 2 zones right here after the indicator loads. Now this one is only based off of 1 candle, but what we have down here is 2 demand zones, and then within those 2 demand zones we have a demand zone within a demand zone, right, which is that, and I'll turn it to green right here. So we had a higher concentration of buyers down here. So as price started going down, that's when you saw this buyers sitting here being taken out, because again it was only based off of 1 candle. But when price got down here next to our stop loss, it started having that rejection back up to the upside. Now eventually we got taken out of this trade, and if you look at let me turn this zones indicator off so that the chart is a bit cleaner. If you look at how price ended up going for the rest of the time, this was ideally a stop hunt, because we got stop hunted and then price kept retracing and retracing back up, and from then on price went bullish from here. So again, picked up that liquidity in that demand zone within a demand zone that we saw, and then eventually let me see if I can increase this, or I'll just play this. So you'll see that price ideally, what happened here, we just got faked out, and EU up until now, if I exit this pattern, you'll see that EU turned super bullish. So this was just another stop hunt. Now over the weekend I went ahead and back tested this, or looked at what are some of the things, like for example for that particular trade setup that we could have done, for example, to avoid any losses or stop hunting. Now what I realized, if you have a demand zone or a supply zone that's only based off of 1 candle, you should wait for price to go to either a demand zone or a supply zone that's based off of more than 1 candle, what I normally call supply zone within a supply zone, or a demand zone within a demand zone. So you want to, as much as your trade setup can validate in a supply zone or demand zone, ask yourself, is there any zone above or below that, depending on what you're trying to, what direction you're trying to trade in, that has a higher concentration, because think of price as moving from one pocket of liquidity to the next. But anyway, this was just a learning experience. Now the other thing, trading on Friday is a bit tricky. I've definitely had nice or good trades on Fridays, but I've also had terrible trades on Fridays. So the other thing going forward, one thing I've noticed is that some of these trade setups, especially on Friday, come around what time was this? Around like 1 p.m. to 2 p.m. ish, and not like immediately like in the morning session beginning of New York. So maybe going forward I'll also probably be holding off trading on Friday, maybe post 12 p.m. Eastern time, because I've noticed that in the past that sometimes before 12 noon, sometimes price just goes the opposite of what you'd expect. So even if the trade is valid, because you have to keep in mind, on Fridays the Asia session has already closed for the weekend, right? So at some point you're only left with the New York and London session during that crossover period. And then when London closes, which is about, I want to say 12 p.m. Eastern Standard Time, or 12 noon Eastern Standard Time, or 11 a.m. Eastern Standard Time, around that time, that's when the London session closes. Then you're only left with New York liquidity. So at that point, that opens up a lot of pockets for manipulation. So that's why I'm talking about, like, after that 11 a.m. or 12 noon time, I do see that before ideally around that period, manipulation has ended and price would go in probably the direction you're looking at. But anyway, that's something I'll forward test going forward. But the new thing for this one is just that just looking at where do you have supply zones within supply zones, where do you have demand zones within demand zones. But other than that, that will be it. So this was unfortunately minus 0.75% return, so I went ahead and recorded that. So if we go to the February results, you'll see on Friday I recorded that as minus 0.75. So for the month of February, we're still up 0.75. And yesterday we did not have any trades actually. So let me just record that, and we'll see how today goes. If we have any other trade setup for this week, we'll just record that. But other than that, that will be it for this trading recap. I'll catch you guys in the next one. Peace.